One of the most frequently asked questions we get about using unusual option activity is, are these unusual options a hedge for buying stock or selling stock? Because if it's a hedge, then it could be the complete opposite direction to our analysis of where this stock is going to go. And so this is very important, and we're going to use Google as an example since we saw unusual options that were a hedge with stock buying in this case. And so without further ado, let's get right to it. So if we look at the options tape on the last trading day for Google, you'll see here at 10:12, the largest one was this April 28 105 strike calls here at 2,728. You'll also see that at 12:30, the same trade was also made, 2,000 of them this time, and then at 11:37, same strike, same date, different quantity. Also down here, 12:31 and 10:13, all these 105 strike calls. And what you'll notice is that even when they had different time periods, saying that they weren't simultaneously placed at the same time, they're showing as spreads under the condition column. You see this is a spread, and a spread, right? And usually a spread is that means that there is another contract, an option, or a stock that's connected with this trade. And so, for example, if we looked at the last minute here, we had these May 19 105s. You'll see 45 contracts. They were done all at the same time, same second. This is the one trade that had was a spread. That's why the condition says spread here, right? So if we look at the this 10-12 one, then is there an option or a stock that's connected with that? Well, let's take a look at the 10-12 one, and we can also take a look at the 1137 one. Okay, take a look at just those two just to save some time. So 10-12, we scroll down to the 10-12 and see if what option is connected, if there is, right, at the 29-second mark. And there we are. We see that trade there, 29 seconds. There are no other 29 seconds. This is 28 is the next one, and 30. So it's just on its own, yet it says spread. Therefore, there must be a stock connected to this, right? A stock trade that's connected to this option trade to make it called a spread under the conditions, right? So that's one of the ways you could tell. And then let's look at that second one, the one that was done at 11:37. Let's see if there was an option connected to that one. It was 11:37. We saw, wasn't it 11? No, we got to go down to all the way to 11:37. There we are. And here we are, 1,862. Also 24 second, there's nothing. This is all 23 seconds, 27 seconds, 27 seconds. So this on its own, only at the 24-second mark, this trade was put on, and it says spread. But where's the other leg, the other part of the trade that makes it a spread? It's missing here on the options time in sales. That's because it's on the stock's time in sales, right? So that's how we know. And so if we look at that chain, on the April 28th, we can see here this 105 strike calls is right here, right? And so what's happening here at this strike price is that either they are buying this as a covered stock. You'll see here it's under the spread, it's called a covered. This one is would be called a covered call strategy, you'll see, right? And or they could also be selling also covered stock, which is the opposite. This we don't know which one it is, but we definitely just know that it is a covered strategy because it's under the spread. That's why, because of the condition says spread. So in the case of a covered call, let's say they bought 100 shares, right, of Google, and then they sold one call at the 105 strike price. That lowers their break even from 105 down. At expiration, this is their new break even on April 28. So this stock can go all the way down to 102.6 and they won't be at a loss. You see here, this is the profit loss on the y-axis. Anything above that is profit, below is loss. This is all above that zero line here at expiration. The blue line is the expiration line. You'll see as this date gets closer to expiration, it becomes the blue line, right? And so same thing with this position. This is a short position where they are basically selling 100 shares of Google, shorting Google, and then buying the 1/0 strike calls, right, as a hedge to limit their potential loss if the stock actually rallies up. Instead, they won't be at a considerable loss because they had a hedge on. They bought that 105 strike as a hedge here. So this is why this is flat here. Their loss here is will not increase as it increases. So it's stuck here at negative 200, right? So that's a hedge for a short. The thing to keep in mind is we don't know, as I mentioned, if this was if they bought 100 shares or sold 100 shares or sold the calls or bought the calls. It's still indeterminate with the current information we have there. We have to do further deep dive analysis, especially since the volume here at 33,000 is less than the open interest at 34,000. So we don't know whether or not these are closing orders or opening orders. So, but let's assume it was, let's say they were buying the shares and selling the calls, which typically is more probable for maybe potential earnings, because you usually want to sell options instead of buy options when you're near higher volatility in your earnings. So they basically reduce their cost basis down to about 102.6, which is about here. So the stock right here can drop all the way down here and they would not be at a loss. So essentially lowering their break even. So they're buying the stock for 102.6 instead of that 105 price, because they sold that option. So that reduces that cost basis. Okay, so this is how you can tell by looking at the spread condition on the options. If you want to also learn a little bit about what we think about earnings, this is coming out for Google's. We're going to put a link at the end of this video for our Google analysis on earnings using unusual options. We are monitoring Google, and so If you haven't watched our videos on that, we did that last week on Tesla and correctly predicted the drop in Tesla and made over 100% profit on that. You can watch that video too. We'll put that at the end of this video as well. So yeah, these unusual options are very helpful in predicting stock moves because these are done by large institutions. Okay, I hope this was helpful in answering that question that we commonly get. Again, there are many other variables to analyze things to determine exactly what these unusual options mean. And with experience, and if you watch more of our videos, you'll start to learn more and more about it. All right, subscribe if you haven't, and please smash that like button if this was helpful. It really helps us and encourages us to make more videos and put content out there for everybody to learn. Take care, everybody, and good luck.